Nigeria's push for industrial growth is gaining fresh momentum as the federal government begins a comprehensive review of tariff policies aimed at strengthening local production, protecting domestic industries, and lowering the cost of doing business. The move follows a high-level engagement between the Tariff Review Board and the Minister of State for Finance, Dr. Doris Uzoka Anite, where existing tariff structure were carefully examined against realities of rising production costs, foreign exchange pressure, and global trade volatility. A very warm welcome to Business Point, where we extract the Nigerian economy and the government policies. I am Kike Lomo Okere. At the meeting, attention was placed on aligning tariff regime with federal government's broader industrialization agenda. Discussion centered on how tariff can better support local manufacturers, reduce structural bottlenecks, and stimulate growth across key value chains, while still allowing the importation of essential raw materials and intermediate goods. The government made it clear that the review is designed to reposition tariff as catalyst for economic development rather than an obstacle to productivity. The focus is on creating a more responsive and flexible tariff framework that encourages domestic production, shield homegrown industries from unfair competition, and improve competitiveness in manufacturing sector. Officials also assess the impact of current tariff policies on sector heavily reliant on imported inputs, identifying areas where high duties have increased production costs and constrained output. Options for the targeted fiscal relief were considered to help manufacturers manage input costs, sustain operations, as well as preserve jobs, expand capacity. A strong emphasis was placed on data-driven policy making, with consensus that any tariff adjustment must be guided by clear evidence of their effect on production costs, consumers' price, employment, and investment flows. The goal is to ensure market stability while adapting to shifting global trade dynamics by refining tariff policies as strategic fiscal tool. The federal government aims to unlock industrial capacity, attract fresh investment, deepen local value addition, and build a resilient, competitive, and inclusive Nigeria economy. The planned tariff review signals a shift from the revenue-focused trade policies to growth-oriented industrial support. If carefully implemented, it could ease pressure on manufacturers, boost local output, and reduce import dependence. However, success will depend on striking the balance, protecting domestic industry without triggering higher consumers' price or supply shortage. Data-driven execution will be critical to delivering real economic impact. Efforts to cushion the impact of the Heritage Bank collapse have gained renewed momentum as the Nigerian Deposit Insurance Corporation recovers additional 24.3 billion naira from the bank liquidated assets, boosting repayments to affected depositors. The recovery realized through aggressive debt collection, sales of physical assets, and the liquidation of investments is targeted at customers whose account balance exceeded the statutory insured limit of 5 million naira. At the time the bank's license was revoked, Heritage Bank operating license was withdrawn by the Central Bank of Nigeria on June 3, 2024, after NDIC was appointed liquidator in line with the provision of the Banks and Other Financial Institutions Act 2020 and the NDIC Act 2023. Since then, the corporation has been working to recover value from the bank's assets and return funds to depositors. With this latest recovery, the NDIC has declared a second liquidation dividend, bringing cumulative pay out to 14.4 kobo for every naira owed to eligible depositors. The new tranche will be paid automatically into depositors' alternative bank accounts already captured in NDIC records. Using their bank verification numbers, customers are advised to confirm credit directly with their banks. Depositors who are yet to receive either their insured sum of up to 5 million naira or earlier liquidation payment have been encouraged to visit NDIC office nationwide or submit claims through Corporation Online e-claims platform for faster processing. Earlier in April 2025, the NDIC paid out 46.6 billion naira as the first liquidation dividend, representing 9.2 kobo per naira to depositors with balance above the insured threshold. Together, the two tranches underscores the corporation's ongoing effort to maximize asset recovery and reduce losses suffered by the customers. The NDIC clarified that liquidation dividends are paid only after insured deposits have been settled and are funded strictly from recovered assets and outstanding debt of the failed bank. Other creditors and shareholders will only be considered after all depositors have been carefully reimbursed. Subject to availability fund, the corporation also assured depositors that further payment will follow as more assets are realized and additional debt recovered, reaffirming its commitment to protecting depositors and maintaining confidence in the Nigerian bank. The additional 24.3 billion naira recovery highlights the NDIC active role in managing bank failures and safeguarding depositors' interest. While the cumulative payout offers some relief, the relative modest kobo per naira recovery reflects the depth of the asset erosion at the failed bank. Sustained asset recovery and timely payouts will be crucial in reinforcing public trust in the financial system and deposit insurance framework. Global oil markets are back on edge as crude price climbed above $63 per barrel mark, driven by rising geopolitical tension and renewed fear of supply disruption in key producing regions. Data from oilprice.com shows that oil price gained momentum from late last week, extending a rebound that followed 2 days after losses. The rally was largely triggered by escalating unrest in Iran, one of the Middle East's major oil producers, raising concern that prolonged instability could threaten crude supply flows. Both major benchmarks moved higher as traders priced in growing supply risk. Brent crude surged by $62 on Friday and reached about $63.34 per barrel by Sunday, while U.S. benchmark West Texas Intermediate traded around $59.12 per barrel. The gains marked a second consecutive day of upward movement, reflecting heightened sensitivity to geopolitical development. The market reaction followed a sharp jump of more than 3% on Thursday as tension intensified across several oil-producing regions, including Iran, Venezuela, Iraq, and Russia. Investor sentiment shifted rapidly from supply surplus consigned to fear of near-term disruption, particularly in Iran, where widespread protests have continued to escalate. Development in Iran dominates market focus after reports of deepening political instability, government crackdowns, and restricted internet access. The unrest has heightened uncertainty over the country's oil output and export capacity, pushing traders to factor in risk premium. Earlier in the week, oil price had come under pressure on expectation of increased supply from Venezuela after signal of renewed oil flows to the United States. That prospect briefly drove Brent below $60 per barrel and West Texas Intermediate to near $56 as markets anticipate additional heavy crude reaching U.S. refinery. However, the renewed instability in Iran quickly overshadowed those supply expectations, reversing the downward trend. As a result, oil price rebounded sharply, with geopolitical risk once again emerging as the dominant driver of the market sentiment. Analysis shows that the rebound in oil price highlights how quickly geopolitical risk can outweigh supply expansion expectations, while potential Venezuela exports initially pressure price. Escalating tension in Iran have restored a risk premium to the market. Sustained instability in major oil-producing regions could keep price elevated in the short term, even as global supply dynamics remain fluid. The Nigerian Customs Service Semi-Area Command has recorded a remarkable revenue performance, closing 2025 with 117% surge in collection and reinforcing its grip on broader security operations. Revenue generated by the command rose sharply to 15.6 billion naira in 2025, more than double the 7.2 billion naira recorded in 2024. The strong performance peaked in December 2025 when the command posted its highest ever monthly revenue of 3.63 billion naira, underscoring a sustained improvement in compliance and operational efficiency. The renewed growth has been linked to the effective implementation of the One-Stop Shop initiative, which strengthened coordination among borders agencies and simplified trade procedure for stakeholders. By streamlining process, the initiative improved trade facilitation, reduced bottlenecks, and enhanced revenue capture at the border. In line with the federal directive, the command also reduced checkpoints along the Lagos-Abidjan corridor to just 2 approved locations. This move significantly eased the movement of legitimate goods, cut the transit delay, and encouraged voluntary compliance, further supporting revenue growth. Beyond revenue, the Semi-Area Command intensified its border security operation to curb smuggling and protect public safety. In December 2025 alone, officers intercepted large consignments of illicit drugs and controlled substance, including hundreds of parcels of cannabis, packs of tramadol, and high-dosage sildenafil tablets considered unsafe for consumption. These seizures were a result of intelligence-driven enforcement, strengthened patrol, improved risk profiling, and closer collaboration with other security and regulatory agencies. The command noted that these measures have helped to strike a balance between facilitating trade and maintaining strict border control. This signals the sharp rise in revenue as the semi-border underscores how operational reform and trade facilitation can translate into stronger fiscal outcomes. This combination of the streamlined border process and target enforcement appears to be reducing leakages while discouraging illicit trade. If sustained, this model could boost revenue nationwide without disrupting legitimate cross-border commerce. All right, let's take a quick short break now. We'll be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, it's Business Points, where we x-ray the Nigerian economy and the government policies. Nigerian productivity sector are facing renewed pressure as banks sharply reduce lending to manufacturers and traders in the first half of 2025, reflecting growing caution amid economic headwinds. Data analysis shows that bank loans to manufacturing and trade fell by 2.1 trillion naira between January and June 2025, dropping to 10.95 trillion naira from 13.07 trillion naira at the end of 2024. This represents a steep 16.2% contraction, underscoring tighter credit conditions for businesses already grappling with high operating costs, weak consumer demand, and elevated interest rates. The manufacturing sector took the biggest hit. Bank credit to manufacturers declined by 1.44 trillion naira, that is 16.8%, falling to 7.09 trillion naira by the end of June from 8.53 trillion naira 6 months earlier. The pullback has limited access to working capital and expansion funding at a time when manufacturers are struggling with energy costs, infrastructure gap, and forest constraint. Lending to the trade and general commerce sector also weakened, with bank cutting exposure by 682 billion naira, that is 15%, to 3.86 trillion naira over the same period. The decline points to the reduced appetite for risk in consumers facing businesses as inflation continues to erode purchasing power. Other key sectors were not spared. Credit to education dropped by 11% to 79.4 billion naira, while real estate loan fell by 5.5% to 904.2 billion naira. Lending to sundry activities classified under general saw the sharpest percentage drop, plunging by 22% to 4.03 trillion naira. Combined loan to manufacturing, trade, real estate, education, and general activities declined by 3.48 trillion naira, that is 17.5%, to 16.43 trillion naira by the end of June 2025. This contraction dragged total bank credit to the private sector down by 1.06 trillion naira to 58.16 trillion naira, while the combined share of the five sectors in the total private sector credit fell sharply to 28.3% from 33.6% at the end of 2024. The lending slowdown has coincided with weak performance in the manufacturing sector, which has recorded modest growth despite its central role in economic diversification and job creation. Investment inflow into the sector have also fallen significantly, pointing to declining investors' confidence and amid structural bottlenecks, macroeconomic instability, and policy uncertainty. Analysis shows that the sharp contraction in bank lending highlights the strain high interest rates and economic uncertainty are placing on Nigerian real economy. While banks are protecting balance sheets, reduce credit to manufacturing and trade risk, stalling industrial output, employment, and growth. Without targeted credit support, lower financing costs, and structural reform, the productive sector may continue to underperform, slowing broader economic recovery. All right, before we call it a wrap on Business Point today, let's take a quick look at the capital market. The Nigerian equity market extended its bullish run last week as strong investors' appetite for banking, telecoms, industrial and consumer stock lifted market capitalization by 3.84 trillion naira, reinforcing confidence in the equity space. Sustained demand for large cap and fundamental strong stocks pushed total market capitalization to 103.778 trillion naira at the close of trading on Friday, while all share index rose by 3.71% week on week to 162,000. 298.08 points. During the week, the market crossed the 100 trillion naira milestone, a psychological threshold that underscores renewed optimism among investors. The rally gathered pace towards the end of the week, with Friday's session closing firmly in positive territory. The index gained 0.93% on the day, lifting year-to-date return to 4.30%. Heavyweight in the banking and telecom sector dominated trading, with strong demand recorded in MTN Nigeria, Access Holding, GTCO, Zenith Bank, and Jais Bank. Although price advanced strongly, overall trading activity slowed down compared with the previous week. Total volume traded stood at 4.16 billion naira share, valued at 94.03 billion naira across 248,254 deals, down from 7.82 billion shares worth 134.47 billion naira exchanged a week earlier. Trading peaked midweek before tapping towards Friday, reflecting selective participation as investors focus on quality stock. The financial service sector led market activities, accounting for nearly two-thirds of total traded volume and over 38% of total value. The service and the ICT sector followed, driven by steady interest in telecoms and service-oriented stock. Market breadth remained firmly positive, with 84 stocks recording price gains during the week, outspacing the 22 decliners. This broad-based participation signaled widespread investors' confidence rather than gains driven by a narrow set of stocks. Mining, healthcare, and insurance names feature prominently among the top gainers, while losses were limited to relatively small group of equity. All sectoral indices closed higher, except the sovereign bond index, which ended the week flat. Exchange-traded products recorded lower activities, pointing to investors' stronger preference for equity over alternative instruments. Corporate activities also supported market depth, with First Holdco increasing its share capital following the listing of additional ordinary shares, expanding its issued share base and improving liquidity. Analysis shows that the 3.84 trillion naira market gain reflects a renewed rotation into equities as investors position for improved earning and attractive valuation in blue chip stocks. Crossing the 100 trillion naira mark has strengthened market sentiment, but sustained gain will depend on earning performance, macroeconomic stability, and continued investors' confidence. If buying momentum holds, the markets could attract fresh inflow in the near term. All right, this is where we'll call it a wrap on Business Point today. Join me again next time on Global Television, channel 365 on DSTV and 276 on StarTime. To stay connected, kindly follow us on all our social media platforms using @GlobalTVNG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.